Hello everyone, and welcome back if you were with us for the first section of this webinar today. In case you have just joined midway, or if you've just joined us, this is going to be the start of a new recording. So because it's the start, I just have to quickly go through the disclaimer again that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And just very quickly, we will obviously be looking at the charts. We're going to be looking at stocks and indices through the prism of our methodology, which we call volume price analysis. And it's volume price analysis is a term that David and I came up with 10 years ago. It didn't exist before then. So it's something it's our baby, as it were, and it's the relationship between price action and volume. It's not this relationship between these two leading indicators is not new. We didn't invent it. It's also in Wyckoff theory. What we've done is we looked at it, we studied it, and we kind of added our own spin to it. And a lot of traders who have taken it on board have made it their own, because once you understand what you're looking at on the chart in terms of price action and volume, that is your foundation, and then you can build on that whatever you like. You put your own indicators on it. You can put standard indicators, proprietary indicators. We have our own proprietary indicators, as I know some of you know already, but it's where you start. It helps you deconstruct what is happening on the chart in terms of its structure. Are you in a trend? Are you in a congestion phase? Because if you don't know that, you really are, you're going to be lost into what is likely to be happening next. And we can only show you that by looking at charts. But the beauty about volume price analysis is once you learn to recognize those turning points, those structures, how the interaction, what the interaction between price action and volume is telling you, they just keep repeating all the time, which is why we've also come up with some books of examples. There are books of examples from stocks, from commodities, from indices, and there's also one for Forex as well. And what it does, what VPA does, it kind of confirms the price action or not. And as I said, it will just keep repeating. How we've kind of adapted or moved on from Wyckoff, taking the basic principles, is that we use candles and candle patterns rather than price bars. And the support and resistance, we look at support and resistance through price-based support and resistance, and also volume-based support and resistance. But you can have your own method. You might like to use trend lines. You might like to use Fibonacci. You might like to use Elliott wave. It really doesn't matter, because when the price hits one of those significant levels, say a Fibonacci level, how do you know it is either going to go through or is it going to reverse from that point without volume? You really don't. Doesn't mean it doesn't, price action on its own doesn't work. Of course not. Lots of traders just use price action, but just gives you that additional validation, if you like, of what you are seeing on the chart. Right, so that's very briefly VPA. If you were with us in the first part of this webinar, you will have heard me say that where we started with the Forex. And what I also said to those of you who were with us but weren't Forex specific, but sort of stocks and indices, why I think you should know what is happening in the Forex world, particularly with the US dollar, because the US dollar has a very, very close relationship to what is happening with bond yields. It tracks it. The US dollar, I'm just going to bring it up on my, this is my MT4 platform. I've got the DXY, and I'm looking at the monthly chart of the DXY. This is last month's candle. And even if you were just looking at the price action on that candle and understanding the relationship between the dollar, stocks, and the bond market, what is that telling you? Well, the dollar has been on an absolute rampage since where we're 2021. I have mentioned this before. The dollar is also has a very close tie to the presidential cycle. So when you have a democratic administration, the dollar does strengthen, and all you have to do is pull up a dollar index chart. Go to the one on investing.com, because it's got you can hit the maximum, and you can you go back a long way, and you look at the presidential cycle, and often, more than often, you will find that it strengthens when there is a democratic administration. A strong dollar, a very strong dollar, is not necessarily a problem for the US, but it can become a huge problem for the global economy, particularly those economies that have borrowed in dollars, because obviously their borrowing costs are going to be much higher. Last month's candle, we see here, we had this huge up candle, and then it came off as the months closed out. So you have a wick to the top of the candle. There's a lot of volume underneath it. As I said, just on the price action alone, what is that telling you? Well, the dollar is going to come off. This is the dollar index. A weaker dollar is tied to bond yields. Bond yields have fallen slightly. That is positive for risk assets, such as. Am I making a banging noise again? Oh Lord, I do apologize if you hear a slight sort of, and I don't understand why on my headset. David's just trying to sort it out, because you really don't want to hear a sort of knocking noise at the back. If it's causing a problem, please let me know, and I'll move over to a different headset, or at least stay very, very still, and try and get the problem resolved for next time. So you have this big spike to the top of this candle. This is telling us, that the dollar is going to weaken. May not weaken for very much. As we saw it here, we had a big up candle, not so much of a spike on this one, and it did actually follow through before it closed out that month lower, but then it's been back on its rampage, and even though we had a bit of a fall off there, it's still carried on high. Now, what's interesting about last month's candle is it triggered what we call a volatility signal. These are these two little purple arrows, top and bottom of the candle. That tells us that this price action that we had last month was very much outside the average true range for this particular time frame. This is the monthly chart. When you see this kind of trigger, it is a hugely important signal, and particularly when associated with a wick to the top of the candle, and you've also got a lot of volume underneath it, that is definitely telling us that there is weakness coming ahead. And it also tells us that the price action, more often than not, will retrace to within the spread of this candle, which it has. It may actually continue within this spread until such point as we get a definitive direction, and this is where support and resistance comes in. The high and the low of this candle, it's a very, very wide spread, are now the key levels that we need to watch, but it may simply move sideways. For forex traders and on much shorter time frames, faster time frames, you're still going to get quite wide-ranging candles. It's not really going to have a huge impact, only to the extent that just to be aware that if the price then starts to approach the extremes of this candle, beware. And it's also a lesson that at the end of a month, before as we move into a new month, and we're also moving into the final quarter of this year with its association with Santa's rally, and yes, it is only October, we already have to talk about Santa, and we've got earnings this quarter, the final quarter. We've also got another Fed meeting, we've got the NFP on Friday. It is going to be a very, very lively time, coming up to the end of the year, and we'll see whether in fact we have a bit of a turnaround in December going into January, as I said, the traditional Santa's rally. Well, certainly judging by how October has started, a lot of market participants seem to agree with that view. So as I said, doesn't matter what you trade, really have to know what the US dollar is doing. And you know, you can find the dollar index charts all over the place. I would also say this particular index is it is quite heavily skewed to the euro. There is another one that the Fed actually uses. I think it's a more equal weight one, but to be honest, a lot of people just look at the DXY, which is what this is, and they say, yeah, you know, dollar strong, dollar weak. Just gives them a snapshot of what the dollar is up to at the moment. Very, very important that we all know that. Right, what have we got here? I've got Ninja Trader. And let's have a look. This is the, I'm going to do two things. I'm going to have a look at, I'm just going to have a look at how we've ended today. And then I'm also going to have a look at the SOXL. And the reason I'm having a look at the SOXL is because, you know, I mentioned about these signals that we get with volume price analysis. And I suppose with volume price analysis, what we're looking for all the time, we're looking for validation, we're looking for an agreement between the price action and the volume. And when we don't find that agreement, then it's an anomaly. And anomalies tell us all sorts of things that, you know, of what is likely to be happening behind the scenes, you know, of that chart. And there has just been a fantastic example. This is actually highlighted for me by one of my Twitter followers. He, the trader, got terribly excited. This ETF, not one that I am overly familiar with, because it is actually a three times leverage ETF for semiconductors. It's a really unusual ETF. Very much used for day trading. It's backed by all the sort of big semiconductor companies such as Nvidia, Qualcomm, Broadcom, and I think it's got some, it's one of its constituents is also a fund. I must confess I'd never come across them before. ETFs are a very important section that we have included in our upcoming stock program. The stock program, you know, we tried to cover everything that we believe you need to be aware of, whether you are a trader or an investor. There's a big section on options, not necessarily for option traders, but it's how you can use the options market to not only determine whether, you know, how far a stock or an index is likely to move, but it also gives you a sense of the risk that is out there in the market. Because we talk about VPA and we look at a chart and we can analyze a chart and we look at the signals and we find the anomalies and we can see the turning points, etc., etc. But ultimately, your success will also depend on your risk management. And what VPA also tells you is, you know, are you looking, is this more likely to be a risky trade or a risky investment? Now, there's no formula that will actually, you know, there's no statistical formula that will say, yeah, this is, you know, this is what is the level of risk. But when you look at a chart and you look at, you know, the candles, I mean, this is a good example here. We've got volatility. We've obviously got a distribution there. You know, the risk going long in a, you know, when you get this, this typical distribution top is much greater than if you were looking maybe at a, you know, at a breakout or a price action that is in a, you know, the chart is structured in a very, very different way. So I'll come back to the SOXL and the signal that he has picked up. Maybe some of you have spotted it already. It was on the weekly chart. He got terribly excited, but I actually took the analysis one step further, and I said, look, you really have to look this in multiple time frames, and we'll see that. Moving back to the indices, I've got the SPYs, the Qs, and the DIA, which is obviously the Dow. And let's look for the NASDAQ. Those of you who were with us earlier, I've actually been trading the Nasdaq via my MT4 platform, basically as a CFD. We have that luxury here in the UK. I was actually short until Monday, and it's been a very, very nice, profitable trade. And really, Monday was the start of the new trading month. And what happened is the price action ended on Friday on this. This is a support that's derived from the volume point of control, and there was no indication after really September that the indices and stocks would not carry on lower. We still have problems with inflation. We have a labor market that is what's called tight. In other words, people are still in employment. There are still jobs available. In fact, there's a shortage of workers, and when you get that scenario, in fact, that is likely to drive inflation higher. I have written a little post about it on my Facebook page, explaining in the 90s, we had a chancellor here and a prime minister who basically said that unemployment was a price worth paying to bring down inflation. And the Fed, Powell and the Fed members have kind of said that. Now, in the 90s, that was, there was a horrific reaction to that, because obviously people, we think back to the days of the 30s and the Depression, and you think, you really want people to be thrown out of work. Now, clearly, we have moved on with support for the unemployed, etc., etc. And you may still think, well, that's a terrible approach to take to squeeze inflation out of the system. And the reason central banks they're willing to sacrifice, if you like, the labor market to squeeze inflation out, because inflation, when it takes hold in a severe way, will actually destroy people's wealth. And that's not just the top 10%, but that's everybody. And you only have to look at places like Argentina, places like Venezuela, and places like Zimbabwe. It is a firestorm, but it's not a cut and dry situation. So it's much more nuanced than that. And central bankers and politicians have to be careful about what they say. It is a very, very difficult situation at the moment. We will know more about where we are with the employment market on Friday, because we have the NFP. However, the market has taken it upon itself that looking forward, for whatever reason, it thinks that the worst of inflation, worst of the interest rate hikes are over, that the employment, that the labour market is softening, it's loosening, and we know that this week we've had the jolts. That's the new jobs. They have come down quite strongly, and it's way back, and we're going off to the races again. And we've had gap ups, and we had big candles, and we had a sort of reversal candles. But again, look at the volume underneath it. Does it actually merit this this bounce higher? Has this bounce higher got any legs? Well, we will know that by Friday, and this is where our support and resistance comes in. Certainly the Qs and the NQ, which is the E-mini futures, that's gone straight back into the volume point of control, where it has paused. That we have there, and we have the same thing, exactly the same scenario with the SPY. I think the Dow is that hasn't quite got to the volume point of control, but it's actually been capped at the moment with this price-based resistance line from our accumulation and distribution indicator, as I said, here on NinjaTrader. And the more times that is hit, then the thicker that line becomes, the stronger the resistance. So we will have to wait. Now, look at that volume. You've got a nice big candle there, got a gap up, you've got that one, market's closed. Look at the volume. It's ridiculous. That is the kind of anomaly that we are looking for, because that helps to determine whether this move, is it reaching an exhaustion point. It's all very well price action going up, being marked up by the market makers, but there is no supporting volume underneath it, then it's an anomaly. But as David was showing earlier on cable, it doesn't happen on one candle. You know, it does take maybe, you know, we'll have 2 or 3 possibly marking up and up and up, unless it hits one of these very, very strong resistance lines, and then it just sort of moves sideways until, you know, some other bit of news comes out, or there's an event that happens. I mean, I believe, you know, are we on the brink of nuclear war? The market doesn't seem to think. Who knows what's going to happen? You know, we are truly living in some extraordinary times. So that's what I wanted to say on that one. David, do you want to say something and then I'll come back to SOXL, or can I want to carry on with SOXL? Do you want to carry on? Okay, I'll just carry on with SOXL. If you have any questions, do please put them into the chat box, and either David and I will answer them for you. Right, SOXL. Here we are. Go back to SOXL. Let's have a look. In fact, I've got it on a, because I've got my indicators on there. Let's have a look here. Put over. Let's have a look. You can research background on any stock or ETF. You can. There's lots of free resources out there. There's obviously FinViz. I use FinViz quite a lot. We'll be recommending FinViz as part of the stock program for selection, for filtering stocks. We've got some other bits of software as well that we've been testing and we're very, very, very happy with. But if you're just starting, then it's always nice to have sort of free stuff. I mean, all you have to do to get rid of the ads on FinViz is just to sign up. I've got it signed up with one of my emails, and you don't get the you don't get the ads flashing all over the place. You don't get, not all the features are unlocked, but certainly for a start, it's absolutely brilliant. And not only that, there is so much that you can pick up about a particular stock, or in this case an ETF. Now, the signal that my Twitter friend came up with was this candle here, which I hope you can see. It's a very narrow spread candle on a ton of volume. And if we look at the average volume for this ETF, it's 77 million. This is the average volume. The volume that came in was 80 million on a day. And in fact, what it also does, if you look at what's been meant, you know, the social media, what's been, you know, the comments about SOXL, there has been this massive influx of money going into this particular ETF. Now, as somebody else pointed out on Twitter, it's quite unusual, because leveraged ETFs, first of all, they are high risk instruments. They are only really suggested if you're a day, you know, for very short term trading. There's all sorts of reasons for that. Other people take a different view. The person who pointed this out to me takes the view that he thinks this is, he's looking at on a more long-term basis. I have no opinion either way. I can't give an opinion as to whether he should or he should not do so. I can only give a comment on what I see in terms of VPA, and to say that yes, it is anomalous, and we can see the actual ETF has lost a year. I think it's lost closer to 80%. In fact, year to date, it's lost over 80%, and now it's had this jump higher, and we can see the same. Let's have a look if I can move this up. I think these are from TradingView, these charts. Sometimes they work, sometimes they don't. Let's pull it up. Right, that's the day. Let's move to the week. And this is really a good way to learn VPA, is just to look. So you have of the falling prices, but you have rising, and you have this anomaly. And yes, you have rising volume, but look at the spread of the candle. If that was going to carry on lower, that candle should be much deeper. It's not. So there must be buying in there. And we know there's buying in there now because it's been confirmed by, by the media. And, you can read about it on sites such as Market Beat and Finviz. So yes, you have falling prices and rising volume, which is what we want to see, but you also have to look at the spread of the candle. So that is anomalous. So that is, there is buying under there. And in fact, we have had, that was last week, and this week we've had a really nice bounce higher. But to move to, so this is what he saw on the weekly chart. It's also, he doesn't use the volume point of control, and I would have said simply because it got to this support here, as we saw here, it did actually bounce and it's actually come to test it. So you've got a really nice double bottom as well. Now that's the weekly chart. You should always look at things in multiple time frames. So we look at the monthly. Let's move over to the monthly chart, and this is where I thought it was at its most interesting. Right, what do we see here? We have, I suppose, what we call a fallen angel. So we've gone from $5 down here, and we got up to over $70. Let me just see if I can move that out of the way. Yes, it went up to $75 before there was just, a cataclysmic top, and there was climatic climatic price action. We can see the volatility candles, not a huge amount of volume under these big candles, so you knew it wasn't going to go very far. It's gone from 70 and it's actually come down here back to about $8. And what my only comment was, yes, it was an anomaly on one time frame, but you need to place that time frame in the context of a higher time frame to see whether you've actually reached one of these key potential reversal points. And in fact, if you look back over here to the left of the chart, you can see the channel that the price action was in previously. We've got the volume point of control at about, I think, just $13, and we've got this very, very strong support platform here just over, I think it's roughly $6. So it's in this, what I call this price channel. So if it is going to carry on higher, and this is, last month was another nice anomaly because you had rising volume, falling prices, but the range of that candle, I wouldn't say it's half that one, but it's certainly, with that amount of volume, I would have expected that candle to come down here somewhere, to be more in keeping with the range of the volume, with the range of the candle. It wasn't. So there must be buying in there. Inevitably, there's price support coming in, and we see, and we've had duly it has reversed. But moving forward, is that going to be enough to actually push it through the $13? So $13 is really the key level to the upside. Now, if it doesn't manage, to go through there, you've still got this very strong platform support that's been built back over there before it broke to the upside. So there we are. So one signal that you will see repeated again and again on different charts in different time frames, you must put that into the context of support and resistance. However you mark your support and resistance. So we've got Camarilla, we've got, we use volume from the volume point of control. We have price-based support in the shape of the accumulation and distribution indicator. You might like to use trend lines. You might like to use Fibonacci levels. It really doesn't matter. As long as you put it into some kind of context in terms of support and resistance, and then you can decide whether, is this going to be something that you want to, this move you want to participate in? Is this a trade that you think is has got some legs? Because, as I said, as traders, that's what we are trying to do all the time. We're trying to find these turning points, these trading opportunities that will allow us to exploit what is likely to happen next. And as far as David and I are concerned, we really do think that volume price analysis gives you that little bit of extra confidence, that little edge that you need. You say, yeah, I think this is this is the risk on the trade is not huge, and I can put my money into the market. And at the same time, you will be trading with the insiders. You're trading with the people who actually are moving this market. You really don't want to be trading against them. Most people do, so they buy at the top and they sell at the bottom. Because if you think about it, you see this price going up, all the emotions that are being triggered, mainly FOMO, fear of missing out, it's shot up. Then you have a doji, then it shoots up again. You think, oh gosh, I've missed that one. Now I've missed that one. The third time, right, in I go, and then bang, down it goes down. This business is deeply, deeply cynical. Doesn't mean you have to be cynical. You just have to accept that it is a cynical business. In your personal life, you don't need to be. You have to sort of compartmentalize what you do as a trader and what you do in your personal life. And as I said, despite everything, it is absolutely fascinating, because ultimately it is about emotion, psychology, manipulation. And having spent some time in Tuscany, the home of Machiavelli, I can kind of see where it's all coming from. Right, that's what I want to say. David, can I pass over to you now? Is that okay? And can you say something about the, we've been asked questions about the stock program, what's actually included in it, and I'm going to get David to explain that to you. Just very, very briefly, how we're how we are approaching, teaching traders and investors about stock trading and investing. So thank you. I'm going to say good night here in the UK. It's been a pleasure to be with you this evening. As I said, everything that we've recorded is going to be chopped up in, I wouldn't say bite-sized pieces, but much shorter videos, and they will be going up on YouTube in the next couple of days. We will be back next week. Not sure what we're going to focus on. We'll see. We'll be led by what the market is doing. Might do a little bit on bonds next week. There's been so much to talk about because we've been away, but it's really important to understand about bond yields and which bonds the Fed is paying attention to at the moment. I know I mentioned it in the Forex section. The media will often talk about the 2 and the 10 and even the 30-year bond, but to be honest, at the moment, the Fed is paying attention to the yield on the 3 months and the 18 months. So they're very focused on the short term and getting over what is happening at the moment. But I think bonds, it might be nice to do a little section on bonds, and of course look at more examples of volume price analysis. So I will catch up with you next week. I'll pass you over to David now.